So again, welcome everybody. Thank you to everybody who has had a chance to join here over the lunch hour. Sounds like it maybe a little Zoom problem, but we are going to record this for everyone. So as you recall, we brought in Carey Wallace and Agency Focus at our February meeting this year to kind of help kick us off a year-long series around maximizing agency revenue, private equity, mergers and acquisitions. So as part of our ongoing educational series with Carey, we're going to have a session today that is going to kind of focus on your financials and help you figure out ways to probably maximize your financials to maximize your value in your agency. So with that, I'm going to go ahead and turn it over to Carey and her crew.
Awesome. Thank you, AJ. I appreciate it. I'm going to share here and here we go. So it's a pleasure to be here with all of you guys. Can you see that, AJ? Can you just confirm? Awesome. It's a pleasure to be here with all of you. I would just highlight that if you are not starting from a place where you know your own agency, positioning yourself to acquire someone else could really slow down the process or actually put you at a disadvantage when you're competing with other agencies that have their financial house in order. So we're going to focus on what are some of the ways or spots that could create blind spots inside your financials. In order to do this, I've actually invited a friend of mine. His name is Aaron Stocks. He's with PFS Global, and he does a lot of the accounting work for my clients that are looking for that type of resource. So Aaron, I'd love for you to introduce yourself and give you a little bit of your background, and then we'll dive in.
Sure, let's do it, Carey. Thanks for the intro. My name is Aaron Stocks. I'm the CEO of PFS Global. We provide financial management services, mainly accounting and taxes for agencies specifically. Uh, Pleasure to be here. We got a lot to go through, so I'm pretty excited. And yeah, that's basically it. Thanks, Carey.
All right. So my daughter has a sense of humor. So she started this with, here's the thing, because if you listen to my podcast, I say it all the time. But financial visibility is a non-negotiable in 2025. We actually just recorded a podcast where we were talking to a buyer in the industry, and we asked her what's changed about the M&A marketplace in recent time. And her answer was, buyers and sellers are far more savvy than they've been in recent years. They're actually more selective. They understand the process. They are getting representation. Having that solid financial starting point is incredibly important. And I think it starts to differentiate people that have it or don't have it. And what I mean by that is your financials are clean. You know the insights that are coming off of them. You understand what your discretionary expenses are on your P&L and what your current operating profitability is, but what the potential profitability on your P&L can be. Is oftentimes financials that you report on an annual basis might have a tax strategy involved in those financials, not exactly what your overall profitability would be. So having that visibility is a non-negotiable, in my opinion, if you want to position yourself to either prepare for an internal transition, to hire, to scale, and eventually acquire another agency or potentially exit. Like all of those, the foundation are, you have to know what you've got in your own strength. Aaron, you want to take this one?
Sure. Yeah, I mean, especially as you grow or even acquire agencies or look to acquire agencies, revenue will typically go up because you're spending money on advertising, buying leads, adding producers, acquiring things like that will happen where revenue will pretty much automatically increase. They can also increase just because premiums are going up in the hard market. But what you'll see is your profit will be decreasing. And that's not the worst thing. You might be in a growth mode where you are prioritizing revenue growth on the top line versus your bottom line profitability. But that doesn't always have to be the case. You can do both at the same time. And sometimes you have to refocus after you've had large top line revenue growth. You need to refocus what you're doing in order to maximize your profitability. And that comes from diving into your numbers more.
Yeah. So one of the things you said is so true. Like there's a lot of agencies that last year they had their highest growth year because they're growing, but also because rate gave them a boost. And they're starting to hit a point in their agency where maybe were not getting the same rate increases, and they weren't paying attention to their overall book, where that actually could have a great impact on their overall profitability if they're not staffed appropriately. Not having an overall strategy and understanding your numbers can put you in a position where you've led your agency because you're only focusing on top line revenue or premium, even worse, and you don't actually have a line of sight of what's happening in your agency. So not having that strategy and not understanding why things are happening and how they connect could actually put you in an area that you don't want to be. So the number one blind spot that we see is growth isn't real. That rate increase is actually is masking the growth, or your financials actually have your contingencies and your commission and fee combined. So you're seeing a growth rate that actually has something variable in it, and it's actually not accurately reflecting what your overall growth rate is. So to make sure that your financials are representative of what the industry averages are and the industry standard is incredibly important. I have a couple of fractional CFO clients where their contingency stayed pretty flat, but then they dipped and they're like, no, we're growing. Well, if you look at all of the revenue as a whole, you're going to miss what the actual number is. The other part of this is if you're acquiring and you don't know what your organic growth rate is versus what your growth rate overall from acquisition is, it will skew your numbers and also maybe mask what's happening inside your agency. So making sure you understand and you report your financials in a way that you can get to a true organic growth rate and also be predictive of what your retention rate is, what your new business is, all of those things that go into what your overall growth rate is will position you to have a much better feel for what's happening inside the agency. And that true organic growth rate, if it's not where the industry average is, you will not be in a position of growth and your value will change. So the two biggest indicators of value when you look at all the risk factors inside an agency is the agency growing and is it doing it profitably? Well, if you don't know the true growth rate, you don't know if you're actually checking that box, and you also need to know what should my growth rate be to put me in the top percentile for my agency and my side. So knowing the benchmark and knowing where you are really important. And so just making sure that your numbers are giving you the insights that you need in order to know what to work on. The last thing is looking at that number and not knowing what goes into a number will also not help you know what thing to be able to pay attention to inside your agency. Is it my new business or is it my retention? Knowing that will also tell you what to work on, which processes to take care of. But if you just look at the number and it's skewed by contingencies or acquisitions, you might think we're in great shape, but we're absolutely not.
Yeah, so I think to Carey's point, 5 or 6 years ago, we called it if you had a P&L and a pulse, you could pretty much sell your agency, right? There would be a consolidator out there who would pay you for it. Yeah, I think, over the last few years, we've seen a big change in that, where these buyers, they're factoring in, that you need to have organic growth and not just growth on commissions because premiums are increasing. And so if you don't know what your organic growth rate is, or you don't have organic growth, it does severely hurt the value of your book. And a lot of people will just look at their income statement and say, well, I have growth year over year on commissions. And that's great. But these sophisticated buyers are going to factor a growth rate in of premium increases. So a few things on this. Um, the industry's high margin model, hides inefficiencies. So when there's a struggling business, they do everything they can to cut cost, right? Well, insurance, they don't typically struggle too much, although, the industry is hard like every other industry, but they have this reoccurring revenue. And so it can hide inefficiencies, right? So if you're doing things, when you were under 1 million of total revenue and now you're 3 or 4 million of revenue, and you're doing the same thing, it's probably not correct, only because you need to really focus on updating what you were doing. And that comes from the accounting system that you're using, within the accounting system, using it properly, the entity structure that you're in, and then proper tax planning. a lot of times we get asked like, why is tax planning even in the conversation of, buying or selling agencies or running a proper agency? And because the more money you can retain after tax, obviously the more you can put back into the business to invest.
So the other thing I will tell you is there are a lot of agents. So there's 39,000 independent insurance agencies across the country, and 83% of independent insurance agencies are under 1.25 million. The reason I'm telling you this, there's plenty of people on this call that they're way beyond that threshold. The easiest agency to acquire is under 500 in revenue because the competition is less, they're less sophisticated, and there's a great opportunity to be able to be competitive in that offer. Once you get beyond $1 million in revenue, private equity, large buyers, there's a lot of competition for those agencies. They're not going to have clean financials. They're not going to have sophisticated processes. I would say you being a savvy buyer is incredibly important to know what to look for and be able to navigate through that process. But many agencies don't cross that $1 million threshold because it creates a lifestyle agency, and the money coming off of that, the profitability and the recurring revenue, it's enough, and they don't want to make the investment to go further. So there's a lot of opportunity for acquisition is what I would say. The systems that are utilized in our insurance marketplace, especially the AMS systems that have accounting, are incredibly limited. In order to get some insights out of them, they're the bane of my existence. That's the way I would describe these systems. But being able to make sure that you have a chart of accounts that makes sense, that you are classifying things appropriately, can see the trends, that is incredibly important as well. So if you struggle with that, we have resources to tell you what chart to create, to classify your expenses in an appropriate way so you can use these benchmarks. But having those things, I think, are really, really important, and it helps you minimize your risk inside your agency or when you're evaluating another agency. An agency that is a C Corp will find very quickly when they want to sell why having a tax strategy that makes sense, and doing that and revisiting that, why it's so important, because that double taxation or the structure of the deal will have to be really, really scrutinized in order to make sure you can minimize the tax implication. So there's a lot of planning as you're heading towards a transition of ownership in an agency, or you're buying an agency, that you need to think about sometimes 5 years in advance, especially if you're a C Corp. So knowing that and getting the right advice is incredibly important. So blind spot number one, just to take this home: growth that isn't real. Many agencies scale revenue quickly, but fail to scale their financial infrastructure. And from my perspective, that means the owner is doing the financials, or the owner's wife is doing the financials. They really don't know what they're looking at. They may not understand what trust accounting is. They may not know what things that they need to be gleaning from their financials. It really is a trigger point to say, we need to look at this, and we need to make sure that we're getting the insights out of those financials in a meaningful way. Aaron, do you have any other things to add to that?
No, I think that's right though, right? If you are at a size where, you're doing your own books or the wife is doing the books, and this isn't for everyone. Some people are great and can do their books forever. But for many agencies, they should focus their time on growing the business, or upgrading their system, or their provider that's doing the accounting. Doing it yourself forever, or having your wife do it, isn't always a great option.
Yeah, I would agree. The other thing I would tell you is also, when you're transitioning internally to the next generation, being able to understand what to look for and walking someone through a financial statement and the insights that are there. Lots of agency owners manage by gut, and they know what their trends are and what they're used to seeing, but that's a really hard thing to train somebody else to look for, especially as the marketplace is changing, staffing is changing, technology is pushing efficiency into a different category. I think getting that kind of advice, especially for someone who's never looked at a statement before and might be stepping into leadership, is an incredibly smart investment to make, because you're using the most expensive people in your agency to do that work, and it might not be the most efficient and effective use of their time. So that is something I would think about. So let's talk about blind spot number 2, no reliable financial process. From a fractional CFO standpoint, agents will look at their P&L and they'll see we are operating at a 30% profitability, so that must mean we're doing great. Well, that agency might be in acquisition mode and actually have a really big strain on their cash. Profit and liquidity are very, very different things. So I have an agency right now that the owners want to base their bonuses off of their profitability of the agency, but they forget we're in the middle of a buyout. So that's already accounted for in this long-term debt that we have on our balance sheet. And they're looking at, we're profitable, I get 10% of that profit as my distribution. No, you get 10% after all the liabilities are paid. So not having a clear picture of your cash flow inside your agency can create unrealistic expectations, because you're only looking at the bottom line of one statement and not contemplating what that looks like. So not having clear idea of what your cash flow projection is incredibly important. It's one of the most valuable things I think we do for some of our agents, to know, do I have what I need? Sure, you've got the profit, but you may not have the cash in order to make that happen. The second is having no budget or no benchmark. So knowing that you operate at a 17 profitability and you're growing at a 7% growth rate, you might really want to know, but other agencies that are in the 25 percentile are growing at 15% at a 40% profitability. Now you might think about your performance differently. With no benchmark, it's really hard to know, where am I and what should I be thinking about? The other part is how you allocate your resources to your payroll, your marketing, your technology, and how those interact with each other. Having that benchmark can really give you a good line of sight to say, am I taking this train off the tracks, or am I really in a good place for what we want to create inside our agency? Not having those benchmarks creates a little bit of flying blind, and the budget allows you to say what your performance is, what you thought it was going to be, and how allows you to adjust mid-year on some of the decisions that you're making. So for us, we set a budget, and then we also do an annual projection to say, here's everything that's happened. Here's what we believe has been budgeted through year end. Can we adjust on maybe our hiring decisions if we're outperforming our budget? Or should we pull back on some of the decisions because our sales or our expenses, we have some unexpected things? Not having that guide, you wait till the year end to see how you turn out in order to make some decisions. It could actually keep you from being able to have clarity to make some decisions. So those are some of the things that I think having a plan empowers you. It doesn't restrict you. The other thing we do is we actually show someone's profit without contingency and with contingency, so they can really assess what their overall dependence is on income that could not be there, out of their control, like if there's some serious loss in their largest carrier. So not having that line of sight, you can get yourself staffed into a point where you could create a problem for the agency unknowingly, especially since you're part of a network where those contingencies are far more stable than they would be on your own. That is something that you should actually pay attention to and make sure that you're not setting yourself up for a unexpected stressor. The last thing I would say is knowing where your profitability comes from, knowing the profitability by line of business. Is my personal lines profitable, or is my commercial lines really subsidizing my personal lines? That gives you the ability to say, should I rethink my strategy in a line of business? Should I double down in another business and potentially think about changing my strategy of what we are willing to write in our agency because it's unprofitable and it's not something that's making sense overall for the agency? But if you're not if you don't have a good idea of what your profitability by line of business is, or your cost per customer metrics are, you can't make those kinds of decisions. So being able to really analyze your financials to get action is far more creates a result that's far more impactful for an agency that hasn't gone through that process. And by the way, when you sell, that is what the buyer will do, and they will be the benefit of that analysis rather than you doing it in advance and taking the benefit of that analysis and positioning yourself to know all of those insights. The average agency also doesn't get an annual audit. So, I think of the valuations that I've done, which is about 200 a year, I think I've gotten audited financials from less than 10% of the agencies that have sent me financials. So not having someone else review it, you're not getting feedback to know, are there other things that I'm missing? And if your background's not finance, it's very easy to miss some of these insights. So those are the blind spots that I see, that there's magic in these numbers if you know what you're looking for and you're able to get to it, right? And of course, I'm a nerd because I like numbers, but I believe that is what empowers you to be able to know what things to look for and how to use that to your advantage.
I think on this we need to quote Carey, I'm a nerd, and that should be the billboard. No, going off what Carey was saying, I think as agencies get more sophisticated, the requirement or what they should be doing is really departmentalizing and keeping track of the cost of that department. Because, as Carey was saying, as you have personal lines or commercial lines, or sometimes you'll even delegate that down further into additional departments. Knowing which ones are profitable and which ones aren't are very important just for decision making on a month-to-month basis. But also when you go to sell, in some cases, those unprofitable departments, if you've just started them, can be eliminated as an add back potentially, right? Because you're just starting it, you're investing time and money into it. So as you scale and you start departmentalizing, tracking those departments, income and expenses directly to that department becomes more important. Uh, in addition to that, just the month-end closing process is super important. A lot of people kind of see it as a formality, like I close out my books, I get an income statement, it's great. But it really needs to be done quickly, and you need to be able to use that on a monthly basis for your decision making, right? Without it, if you have expenses, they're going to go unreviewed or go out of control. Receivables might sit too long when they should have been collected or policies were canceled, right? And then producers might just be sitting on unprofitable books. You might have a personal lines department that 10 years ago was great, but now they're just sitting on renewals and that department has become unprofitable. So really reviewing your month-end closing process, making sure it's divided by department if you're to that size where you departmentalize it is extremely important. When we get to reviewing the financials, I think that Carey said something earlier that was super important, right? Everyone on this call might have a great understanding of their financials, how to read an income statement and how to read a balance sheet, right? But the generation after you guys might not. The biggest struggle that we have when we have a perpetuation plan that goes to the next generation or, kids or family members is that they don't have that financial literacy that the first generation had before them, right? And so really spending time with them and going through how to read an income statement and balance sheet's important. On that as well, Carey was talking about cash flow. Going through a statement of cash flows as well is probably one of the most complicated financial statements we can go through. But if you do feel like you have a high rate of financial literacy, reviewing that is extremely important and can be super beneficial. We get the question all the time. Me and Carey had one the other day. Hey, thanks for my profit and loss statement. Can you add my loans as expenses on there? And that's not how it works, obviously. And so the number one answer is, well, we need to show you how to read a statement of cash flows because that really is the income statement along with the loans on there.
Yeah, so you put something on here that producers get paid on unprofitable books. There's also another blind spot or leaky area from a producer standpoint. And I know I talk about this, but I'd be remiss if I didn't mention it. So if you do not have sound processes that captures what's really new, what is a rewrite and what is renewal, and your rewrites are actually getting falsely recorded as new to the carrier, but in your system they show as new, and your commission structure is 50 new, 30 renewal, you just paid 20% more on something that was already on your book. So that's mistake number one. Happens all the time. It is uncovered in an acquisition or a transition where someone has savvy processes. They get the benefit of that. And you just paid for that because you're overpaying and you're missing that thing. A group of really, really savvy insurance agencies are part of a mastermind that I'm part of. There was less than 3 people in the room that said that they reconciled their commissions on a regular basis. So there's also the thing you have to reconcile and know what's happening in your financials. The second thing I would tell you is if your structure to pay your producers is I pay you 50 new, 30 renewal, which is rich. So let's go 45 new, 30 renewal, and I pay you that 30 renewal on the entire book. The book's gotten larger, and I also pay service to help maintain that book. That profitability of that agency is going to be different than one that stratifies that book and only pays that producer on the top where 80% of the revenue is and allows that other accounts to become house accounts using that threshold. So having some really strong processes in place can really be a differentiator. The compensation that you pay your employees is always going to make up somewhere around 50% or more of your expenses. If the comp structure is off, it's really hard to make it up in other areas of your agency. So knowing that and being able to quantify that and be able to put a plan in place to write that or set up yourself to make appropriate offers and account for all of those things as you validate producers is incredibly important on the front end. Also being structured in a way where your comp structure makes sense and it's commensurate with the industry allows you to be a stronger buyer, but also, buyers don't want to change comp structures when they buy your agency. So if this is about maximizing the value of your agency, knowing those benchmarks and making sure you align with it is incredibly important. So we actually have a month-end financial checklist. If you don't have one, we're going to share ours with yours. If you want to use that, we'll also provide these there. It's a downloadable thing. You can use it at your leisure. You can also download ours and actually test. Does yours include all of the things that we have, or are there things that you should add to your month-end financial checklist? And again, I'm even happy, Joan, we can send that out. It doesn't really matter, but I just want you to have a resource to know what to do there. So let's talk about blinds. Oh, we already did the month end close. Sorry. So let's do number 3. This is all you, my friends.
All me. All right, flip to the next
All
slide.
you. Yeah.
So,
Yeah.
this is kind of important. And again, taxation doesn't always come up in finance, right? But I think it's super important. You might flip to the next slide, Carey.
Yeah, sure.
I think it's super important that taxation is a topic that's discussed when we're going through the financials. So number one is, not every CPA is made equal. Some are generalists, some specialize in various industries. And finding one that specializes in your industry is super important, right? If you're having a conversation with them and they don't understand agency bill versus direct bill, premiums versus commissions, trust accounting, commission reconciliation, or they want to use a chart of accounts that's specifically built for tax and not for management purposes, then I would really strongly consider interviewing more CPAs that specialize in this industry, right? And that's something that I think is overlooked a lot. We will review returns all the time by other accounting firms that definitely don't know the industry, and we will make recommendations of what should be changed, which will save a significant amount of money. And one thing that people don't get to is just remember, like, if your books are wrong, your taxes are for sure wrong, because the tax returns are based off the books. Flip to the next slide for me, Carey.
Yep. Got it.
So when we're going through and reviewing a tax return at my firm, we'll take the tax return that was prepared for the last 3 years by, the generalist CPA or someone that doesn't know the industry very well, and we'll a lot of times make these recommendations. So here's some common ones that you can go through. So number one is pretty much every independent insurance agency should be an S corporation. If you're a partnership, that can also work. but you typically do not want to be a C corporation. C corporations will not only cause double taxation throughout the year for you, but also when you go to sell the agency, if you ever want to, or even want to have a perpetuation plan to your family members, you'll get hit with double taxation. Making the change takes a while too, so you can't just quickly make the change and pay S corporation rates. It usually takes 5 years for the federal to recognize an S corporation change for an exit. In some states, even longer. Like in California, it's 10 years to make the change. So if you're a C corporation, even if you're thinking about not selling, I'd make the change as soon as possible. Ownership compensation needs to be structured right after you're in an S corporation. So if you're paying yourself a salary of $300,000 per year and you're about to break even with that salary, I would definitely make a change. The whole optimization of the S corporation is to allow distributions, right? And so again, look at your compensation, and if you're well above 100 to 150,000 per year, I would discuss with your accountant or consult with another accountant on how to optimize that. Next will be the pass-through elective tax. So this is something that's on the chopping block right now in the House bill that might pass. But for now, this year and for last year, the pass-through elective tax is available in many states, and I would definitely suggest taking it. And the last thing is the SSTB. So if you're the insurance industry or most independent agents are eligible for the QBI deduction. Every once in a while, maybe on a small handful of returns that we review every month, they're not taking the QBI deduction because the accountant doesn't believe that they qualify, and it's been pretty well documented that they do. The reason why we go through this in the financial planning side, right, is that if you're able to have more after-tax wealth, so more money after tax, that helps you grow and you can invest into your firm.
So Aaron, I'm going to ask you a question on this area. So there are some agencies that might run some discretionary expenses through their P&L. Let's just say that happens, right? What would you say to agencies that do that for a tax strategy for things that are able to be deducted but aren't necessarily vital to selling insurance?
Look, Carey, here's the thing. I don't want to take your line,
I love it.
but there are, like, when we do tax planning, we have a 30-point checklist, right? And 15 of those points, I would say, can save you tax. But once you reach a certain level in your agency, just don't make sense for you to implement, right? Like, yes, you could put your kids on payroll potentially, right? Uh, yes, you can take larger home office deductions. Yeah, you can run your vehicles through the business. But at some point, the smaller deductions like that compared to the ones I just mentioned are a lot less relevant. So my first piece of advice would be don't run everything in the world through the business. We run into that a lot, right, Carey, where everything
Yes.
and I bought a boat that should run through the business. So there are gray areas in taxation, but I wouldn't run everything you can through. Now, when you have some discretionary items that you can run through the business, we can take those for tax purposes, and then they can be added back for EBITDA when they go to sell, right? And that happens all the time. Maybe you have a, you know, more premium health insurance plan than others, or maybe you're contributing to a 401k, or maybe you do have a legitimate home office or a vehicle that you use for business, right? And those things can be added back for EBITDA. But my biggest piece of advice is let's take care of the big fish for tax planning. That'll save you by far the most. And some of the little items we can implement. But if you're, profiting 500,000 or even up to $1 million, these small items, like again, putting your kids on payroll, for example, it just isn't a viable tax strategy. It's going to cost you more money than it's actually worth.
I'll also tell you, it doesn't give you a clear line of sight of what your agency is. So if you are positioning yourself to acquire and you go to a bank for a loan and you have to adjust a whole bunch of stuff off of your financials, it also creates a little bit of a red flag, like, is this really a good loan? And do I want to take the risk on an agency that operates one way, but is telling me they can operate a different way for me to loan them money for an acquisition? So my advice to you is, if you want to be strategic, I think investing in your agency is one of the best investments you can be in, and it's one of the best returns. And if you want to be a strategic buyer, you should run your agency as close to what the optimal profitability is, because it will give you the most ability to continue to grow through both acquisition and investing in your own staff. Because when you run those discretionary expenses, so an exercise we often go through when we bring on a CFO client is, let's go through your budget. Let's talk through anything that's going to be recurring. Let's quantify all of those things so we can create a budget that makes the most sense. When I add up all those discretionary and get to a dollar amount, and that agency is struggling with, I can't hire a producer, it's funny how that number is probably enough to hire 2 producers or whatever, because they were really just utilizing that money for discretionary and not thinking about how they could strategically put that to work inside their agency. So it is something that you should think about, and it's a personal thing, but having knowledge of what that number is and what it could be is incredibly powerful. So
And I think
I
everything in moderation too, right, Carey? Like
right.
a lot of banks or buyers will be like, yeah, okay, the owner's running a personal vehicle through, like not a huge deal. But when you're like deducting everything, like, okay, that was from my, daughter's bar mitzvah or whatever, that's when the banks or buyers just look at you very questionably and like, well, what else are they doing that's not right,
That's right.
right? So
That's right.
again, vehicles and things like that, not a big deal. But when you have some very off the wall things or abnormal expenses, that's when people question it.
So when we put this in here just to share, we get a lot of people that say, "Hey, I need help with my financials." They go through evaluation, they understand like, "Hey, we don't know what we're doing," and we want to position ourselves to either exit in 5 years, or we want to grow. We're not sure what's off. Um, the worst one I've seen is there was a partner buyout, and the way their comp structure was structured, they had no profit in the agency. Like, I couldn't even add back things in order to make them profitable. And they wanted to know the value of their agency so they could buy each other out. And as a multiple of EBITDA, as the way to value an agency, well, if you have no EBITDA, the value's 0. So it was tricky to try and explain to them, I can't just change your comp structure, because the moment I do that, you can't execute it and you won't be able to buy each other out. But you've set up these people actually paid 80 new, 60 renewal onto and they came from the captive world, and that's what they thought everybody did. I've never in my life known someone that does that, but that is probably the worst one I've been on, where they really didn't have the ability to have something to be able to service the loan to buy each other out. So they were kind of stuck until they got their business together. That is a situation I don't see often, but I definitely see comp structures keeping people from being able to position themselves well. Aaron, do you have a worst scenario that you'd like to share?
I think to your point on compensation structures, whether you're trying to scale your agency or someone's looking at buying you or you're looking to acquire, having compensation plans that are all over the place for your producers is like the last thing people want. So whether it's
Yeah.
strange language in your agreements, everyone's got different rates, complicated
Yeah.
calculations, people don't want to see that. But yeah, I mean, there's a lot of acquisitions that have gone bad because they thought their EBITDA number was X and it turns out it's Y. But that just comes with having a good set of financials. But typically, I'll see it when my client is acquiring someone and we're going through the books and records. We ran into one the other day that had a dog as an asset. That was pretty cool. They
Yeah.
were depreciating it. It's like, well, what else is going on in
Huh.
this agency? But yeah.
That's crazy. The other one I'll tell you is, I had an agency. It was a smaller agency, but he was right at 1 million in revenue. And when we got his financials, one of my clients was looking to acquire him. So when we got his financials, he was actually putting premium on his financials, and then cost of goods sold is what was being sent to the carrier. So when you netted that, that was actually the revenue that stays in the agency. The problem is, in his mind, the going rate for his agency was a multiple of revenue, and he was using the top number in his mind. So when we provided an offer to him, he thought he was getting 2.5 times his premium number, not his revenue number, and it was way off from his expectations. And trying to explain that to him was really difficult because that's the way he had done his financials forever. That's the way he was filing his taxes. That's how he was doing everything. So you should never see cost of goods sold on any agency's financials ever. They don't make a product. There is no cost of goods sold. And that's typically a dead giveaway that someone doesn't know what they're doing with those financial statements. But that's probably the worst one because he really was banking on 2.5 times a number that was ridiculous. Like there's PE wouldn't have paid him that number. Like that's just not going to happen. You know what I mean? So,
I run into
um,
that more times too, Carey, maybe even up to 10 times where again they're basically basing it off premium, right? Because that's what's flowing through on their agency bill on their income statement. And we actually have a project right now where we're going back and fixing the last 3 years of that just so an agency can sell. Um,
yeah.
uh, Probably not a lot of people on this call are doing it, but it does happen more than you think.
But the people on this call might be acquiring those agencies. So that's the thing. You're going to get hit with information if you don't know what you're looking at. You could potentially come to a conclusion that's not good. So what do financially healthy agencies do differently? I think we've highlighted some of them. Number one, they run their monthly financial statements. They look at them. They compare them to last year. They compare them to a budget and they compare them to benchmarks in order to say, how's my performance compared to myself last year, compared to other agencies my size, and compared to what I wanted to accomplish this year. Number two, they have a set group of financial metrics that they are monitoring and will take action if they see those numbers not where they want them to be. So what is my growth rate? What is my retention rate? What is my potentially revenue per employee could be one of those metrics. What is my overall profitability? And what is my EBITDA? Those are 5 core metrics that you should know where you stand. And if you're off track on one of them, if it's planned, no problem. But if it's unplanned, how do I need to right the ship in order to make that happen? They look at their balance sheet and they keep their information up to date. Oftentimes the balance sheet is completely forgotten. There's things on there that happened 20 years ago. It's never been amortized. It's never been depreciated. It's just sitting there. And when they go to do something like get a loan or sell their agency, now we've got to clean up a statement and get things moved around. You know, they have a trust account and they stay in trust. Those are all things that financially healthy agencies do differently than other agencies. They reconcile their commission statements. They understand the importance of that, and they don't leave that to chance. Those are the things that I would say financially healthy agencies do. Got anything, Aaron? I don't want to keep from it, but those are the things that come off the top of my head.
No, those were great. I think too, they
Yeah.
just, when they go to acquire and they're going to be adding on debt, they make sure that the agencies that they're being acquired are going to support that debt. So people always fall into the trap of getting in some bidding war and they find out an agency they're buying is just not worth it.
Yeah, I think it's really important. Numbers are just numbers on a page. If they're not telling you a story, then they're absolutely useless. So being able to look and know what you're looking for and be able to turn it into action is probably one of the best things you can do. And we've talked a lot about financial statements, but looking out 2 years, knowing what that projection is and what you need to do in order to achieve the goals of the agency is really, really important. Because if you're just looking month to month, and how you did compared to last month, you might have your head down and not be looking at the horizon and positioning yourself where you need to be. And when you meet that trigger point, you're not positioned well from a cash standpoint, from a profitability standpoint, in order to make that happen. So understanding the story and being able to adjust your plans, being able to understand where you are today, but with a thought of where you want to end in the next 2 to 3 years, I think are really important. And otherwise, just running the reports and looking at the top line number of revenue isn't going to really get you there. That's not the story. That's just one metric on the page.
And
Yeah.
making sure the story matches the financials is important. So if you're going to tell a story about how great your agency is and how it's the best thing since sliced bread, and the financial numbers don't represent that, or that you can't even present the financial numbers in a way that would make sense to someone sophisticated that would buy you or lend you money, that's a huge problem. They got to match.
Agreed. Agreed. Awesome. So what are some things that you could do right now? I think right now you could start tracking your client retention, your liability, profitability, if that's something you're not already doing. You could create a cash flow statement and forecast. If you are in acquisition mode and you're not looking at a cash flow statement, that's an important statement to make to really get your arms around. If you don't talk to your CPA and do any tax planning, reach out to them, say that you want to plan, ask them what suggestions they would make. Like, absolutely utilize that. Aaron, how often do you think an agency owner should be meeting with their tax person in order to properly do their tax planning for the year?
If they're in a relatively stale mode where they're not increasing or decreasing their revenue, they should be during tax time and then once in the off season. If you're someone that's acquiring or active or has large increases or decreases of anything, then you should
Yeah.
be at least once a quarter.
Yeah. And in my opinion, if you haven't done this, get a gut check on your financials. If you don't know what these benchmarks are, you don't know how your performance compares. I think everybody should do a health checkup on their agency, just like you do with your own health, with the equipment in your house, with your cars. Like, we do it for every part of our life, but we don't actually do it for the businesses we run. So that health check for your agency is probably a valuation. It could be a benchmarking. It could be, there's lots of different ways to get that gut check. But if you haven't done that, I think you should do it. It sounds super self-serving, since obviously I do valuations, but how else will you know how you're performing and where you are? So going through that valuation would tell you what your benchmarks are, tell you where your weaknesses are, give you insights on some of those metrics, show you how to calculate it if you're not calculating it yourself. But I think if you have this incredibly valuable asset, you should know exactly how healthy it is and what things you should focus on in order to maximize that value of your agency. We've talked a lot. If there's someone who has some questions specifically, you've got a CPA on the call that you could ask anything to. I'm happy to answer anything about financials. Fire away. We just covered it